Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Thursday. It's June 9th. It's 7:43 in the morning. The market's going to open up in a little bit less than 2 hours, in about an hour and 45 minutes or so. And as you can see here, we are back up. NASDAQ is up 70 points. Dow's up 149 points. Now, typically, in a normal market cycle, I would get really excited about this. But with the 700 point volatility we've been seeing, 149 or 153 points isn't all that much. And again, I'm not really all that happy about markets opening up higher. I prefer markets opening up lower and trending higher. Now, as you could see right here, this is pretty important stuff. I want to show you this. Notice we've been in a very, very tight range. Let me just eliminate all this crap here. It's too many studies, too many things. They don't do you any good. Just kidding. They do you plenty of good. Okay, so as you could see here, we're just in a chop fest right now. Choppiness. This is one of the worst things that can happen for the market in terms of trades, because the markets aren't going anywhere. And you need the market to give you some directional bias so you can make money on stocks. So we're having right now no directional bias and crazy volatility. I mean, look at the Dow. Let me just give you an example of this so you could see what I'm talking about. So look at this. So it appears, now if you look at the numbers, down 279 points, down 300 points, up 148 points this morning, it looks like big numbers. But when you look at the chart, you see that we're literally 1, 2, 3, 4, 5, 6, 7, 8 days. We're not doing anything. We're just sitting in the same range. And the highs, look at this, 33,281, 32,528. Look at 33,200, 32,500. The Dow moved. The Dow moved from, we're talking 700, 800 points a day here. This is craziness. But even with that, what it's doing is it's pushing volatility a little lower, which is really, really good for us. And hopefully, what this is doing is creating a base. Now, if you look at the Russell 2000, which we'll look at right now, it's actually already kind of humming along and breaking out, but I like the fact that it's moving higher. What I really don't want to see is this back away coming back down to the base. That wouldn't be good at all. But the longer we could stay at these levels, the better it would be, and the more we would build a foundation at these levels. So far, so good. Also, again, this is really helping us. The fact that the bond market is losing directional bias. Now, I know the Fed is getting ready to raise rates again next week, but so far, so good. This is really, really good. Sorry about the update. The refresh. But this is good. This is telling us, because look at this. This is telling us that the markets could potentially be consolidating. And if we move up from here, that's less pressure on stocks. Remember, bonds moving higher, less pressure on stocks. Bonds moving lower, more pressure on stocks. Today, the big report that we have to pay attention to is the jobless claims. Now, honestly, I'm going to be very, very straight with you. The number has been really, really solid. So even if we get a little hiccup here, it's not going to be a big deal. So don't make it, unless it's like 400,000 or like 100,000. If it's anywhere within this range, 200,000, 230,000, as long as it's somewhere near the 4-week moving average, it's going to be just a nothing. The big report is the CPI tomorrow, and consumer sentiment would be a big report, but it's coming out. They always find the worst places to put these consumer sentiment reports. They drive me nuts. They can't just put it here or here or here. They have to put it in a day right after the biggest report for inflationary pressure comes out. So the CPI, I wouldn't look at it on a month-to-month basis. I mentioned this yesterday. I would only focus on this report on an annual basis because that's what everybody's looking at. And here's what everybody's looking at. We're looking for clues, signs, some indication from God or the White House or anybody, even Putin at this point. I'm just kidding about that. But we're waiting for just some indication that inflation has peaked out. If inflation peaked out, if this number starts moving lower, then the bond market is going to start turning up, because then there's less pressure on the Fed to raise rates. But that's the big report of the week. And one of the reasons why the markets are so choppy and so consolidating is because everybody is in a wait and see pattern to see what this number is. We're also looking to see what this number will be ex food and energy, But again, the biggest factor is the broad number year over year. I'm hoping the number will go to 8.1 or 8. That would cause a really nice rally in the market. And again, keep your eye on the bond market, because if the bond market starts moving lower, that puts more pressure on the stock market. If the bond market starts moving higher, it puts less pressure on the stock market. Now, as far as stock fetcher goes, as far as our sectors goes, nothing really changed here because obviously we're in a very tight range. So you still have the energy, utilities, basic materials, and healthcare leading. Consumer staples and industrial are kind of on the sidelines. And again, we're still bearish communication services, technology, and consumer discretionary. But I want to just point something out to you. Look how much over the last month, the last 30 days, look how much communication services has lost, and look at how much discretionary has lost. Let me organize this by month. Communication services is right here. We're actually in the upper range, 0.71, not that bad at all. And again, this is the sector that led us down. And if you look at the communication services, actually, in comparison to the broad market, you will see that it's actually moving a little higher. It's still in a very tight range, but at least it's not breaking lower. And what everyone is hoping for is that we take off from here. That would mark this as the bottom. And that would make perfect sense based on the divergence that we're seeing right now between that and the price right here. You see, going down, going higher. So this is a very good sign that we're turning around. Hopefully we won't have any more negative data or inflationary data, or the inflationary data can come at a slower pace to give the stock market some positioning to rebuild. Let's talk a little bit about global economy. Japanese yen has hit a fresh 20-year low against the US dollar. Now, there's a lot of talk about the US dollar rising and the US dollar is gaining strength. But I want you guys to understand something. When you're looking at a value of the US dollar, you're looking at it in comparison to all the other currencies, which are really, really doing bad. So one of the reasons the US dollar is moving so well is because all the other currencies are doing so crappy, number one. Number two, even though US dollar is making all-time highs or swing highs or multi-year highs, whatever, it's doing well. Consider the inflationary pressure. That's causing the dollar's value to be eroded substantially. So the dollar being this high has to be taken into account with the fact that inflationary pressure is at a 40-year high. And when you consider that, you consider how much less the dollar is buying, right? Think about the buying power of a dollar. It's a lot less than a year ago. So while the dollar is making swing highs, you're still buying less with it. So even though it's moving higher, the inflationary pressure is taking a lot of that upside and discounting it. So in comparison to global currencies, the US dollar is doing really, really well. But when you look at it in terms of buying power, well, you guys are all experts in that because you all buy things every day or every week. And I get emails from you complaining at how much less you can buy for $1 now than you could a year ago or 2 years ago, even 3 or 4 years ago. So as you guys know, even though the dollar is getting stronger, you guys all know that it has a lot less buying power right now because of inflation. So you can't look at the dollar in an absolute value. You have to look at the dollar in light of all the other things that are causing it to happen. So the reason it's doing so well is not because the U.S. is just coming out of this amazing economy. It's because all the other economies are doing so crappy and because inflation is taking a huge bite out of it. Hope that makes you guys understand that. So Japanese yen slid to a fresh 20-year low against the dollar, a trend the International Monetary Fund expected for a while because of higher rates in the U.S. and Europe compared to Japan. They want to keep their rates low. They want to do the opposite of what we're doing here. They just want to keep their head down and hopefully things will get better. We're short right now. Just so you guys know, in one of our programs, we're short Sony right now. Sony's an ADR, which means it's a Japanese traded company. So if the yen gets weaker, Sony gets weaker too, right? Because it's a Japanese company. Japanese yen gets weaker. You buy less with it comparison to the dollar. So one of the reasons why I placed this trade was not just because I thought Sony was going down, which I do. I'm kind of bearish on Sony. But one of the reasons for that was also because it's an ADR, and I wanted to take I wanted the Japanese yen to help me in that analysis. That's called multi-level analysis, folks. Not something I recommend for a lot of people at home, at least to begin with. But if you understand how the US dollar works and how currencies works, you can buy or sell stocks that are denominated in the foreign currency. That's why it's called ADR, and that can help you make some money. That just a little lesson there for you. China, China, a whole different animal. China reported export surge 17% over a year earlier. That's great, up from April's 3.7% growth. The more China can export, the quicker we will get this supply chain BS problem and this bottleneck issue resolved. As COVID precautions were eased in Shanghai, other cities, imports rose, accelerated from previous month. China's trade has been slowed by weak export demand and curbs imposed because of COVID. Consumer demand for imports was crushed by rules that confined millions of families to their homes, sometimes for weeks. But factories, shops, and other businesses in Shanghai and Beijing and other cities have been allowed to reopen, which is great for us in America because we need global economy to pick up. The Federal Reserve is believed to be getting ready to raise interest rates again by 0.5 basis points, and that is well priced into this market, as you can see here. It was pricing that in right here. So it's already priced in. What I'm hoping for is that they're going to raise 0.25 basis points, which would cause a beautiful rally, or if they raise by 0.5 point, which is already priced into the market, it won't have much of an impact on the stock market, or it may just cause the bond market to rally because the bond market is appraising all of that in its value right now. And that would be the second time the Fed wants to raise rates by 0.5 basis point. The Fed's goal is to slow economic growth enough to cushion the inflation's impact. It's a balancing act. It's whether or not we're going to go into a recession or we're going to get out of a recession or get out of a recession before it gets bad enough. It's just a balancing act. And the Fed is hoping they can kickstart our economy. And while that's happening, inflation will cool off because of all the COVID overhanging us and so forth. It's a balancing act, and I'm hoping that they will not be kicking the economy into a recession. The Fed's goal is to slow economic growth enough to cushion inflation's impact. Demand for goods has been outpacing supplies, and production capacity is through most of the post-pandemic recovery. So again, it's a big fight right now between the bond market and the stock market. So again, if we're looking at all the sectors, and I just want to show you how choppy the market is. Obviously, energy is still doing well. Utilities are just a chop fest right now. Basic materials are a chop fest. Healthcare is a chop fest. Financials a chop fest. Real estate looks like it's kind of leaning lower. Industrial, I like industrial right now. It looks pretty good. Consumer staples choppy. Technology choppy. Communications a little frisky, but choppy. And consumer discretionary choppy. And I think things are going to stay choppy till we find out where we stand on Friday. Now, today is Thursday. I give you my top ETF and option pick. And I'm still going with the DB Commodity Index Funds, DBC. Now, I recommended it to you folks right here on 4/6. Today is 5/9, right? And it was at 26.37. Well, it's up about 10% since then, and Uncle Roger is still recommending it. Nothing has changed. Let me see here. Let me look at the October options. Oh, you got plenty of liquidity. Just go with the 30 or 31. Don't even spread it. I mean, it's $2.60. I mean, yeah, you could spread it against the 35 or the 36, but it's so cheap, and you have 135 days. This thing can really run up. Folks, we're facing a potential food shortage, and commodity index funds, wheat, soybeans, this is the right place to be in. I would just have this to offset any negative bearish news in the stock market. It's $2.70. It's a great trade. And again, it doesn't expire for 135 days. So you figure you're not even going to have much expiration. You're not going to have a lot of expiration for option decay for at least another 2 months. Not at least, but about 2 months, give or take. Not too much decay. And implied volatility is not like 50 or anything. It's just a little higher than historic, which right now, and based on the fact that it's making swing highs, is not a big issue. But again, I expect these commodities to continue trending. Commodities tend to trend for a good long time. You may want to wait for a pullback to the 8-day moving average, 29.50, or maybe to the 28-ish. But honestly, if you can get it at 28, you're getting a great deal. Again, we recommended it at 26.26 about a little over a month ago. And it's been doing well. And again, with me, things don't change very often. Now, before I let you go, folks, I've got something exciting. I've got something really exciting. I'm doing something I've never done before, or as far as I can remember. I'm doing a 1-hour lunch break on Saturday, day after tomorrow. And it's going to be the coolest thing in the world. And do you know why I want you there? Because a lot of you guys are lost and don't know where the market's going to go. Now, if your trading account is plummeting faster than you can say inflation, don't worry. I have just what you need. I really do. I honestly do. I'm hosting a private workshop at 9 a.m. Eastern Time, Saturday, 11th of June, where you can learn to take control of your financial education. It's not a subscription. It's not a per se strategy. And it's certainly not an indicator for big wins. But I do believe it could be the only way for us to protect our portfolios from further downside pressure. I'm going to show you bullish strategies, bearish strategies, cyclicals, things that when you should be the best day to sell stocks, the best day to buy stocks, the best options to trade, how to find assets that are outperforming, underperforming. I'm going to put it all together and put a bow tie on it and give it to you at the end. It's going to be recorded. You're going to have to watch this at least 3 or 4 times. Look, I'm just being honest with you. It's not one of those things you watch one time and you become a market expert. But it's going to be very concise. It's going to be very exclusive. None of the strategies that I'm going to show you that I've ever shown to anyone before, at least most of them. I'm going to teach you the torpedo strategy. I'm going to teach you the RS bear. I'm going to teach you the RS bull. You guys are going to love this. How to hedge your portfolio, how to find the best short trade, how to find the best long trade, what's the best day of the week to buy stocks, what's the best day of the week to sell stocks, why, right? A system, a bear system that's outperformed the S&P by a huge margin that has over 70% win rate in the last 20 years. All of it is going to be there. You got to follow the link below. You got to get in on this. I cannot wait to see you there on Saturday. And again, you can come in late. You're going to have to watch it a few times anyway. Watch the recording. Get in on this. It's the best money you will spend this year. I've put 3 weeks of my time just preparing for it, okay? This is going to be very, very cool. You guys are going to absolutely love it. And I want you guys in on it. This Saturday, 9 a.m. Eastern Time. I know it's a little early for you, but the early bird catches the worm. Follow the link below. Check out my Plunge Protection Bootcamp for what's working right now in this market and how you can take control of your finances. Do it now, and I'll see you later. Comments, feedback are welcome. Love letters. Where are your love letters? How dare you? Bye, guys. Have a great, great day, and I'll see you tomorrow.